Thank you all for coming out to our last educational event of the year, which we have renamed Food for Thought. So hopefully you guys know that that's what you'll need to look out for. The brunch and learn and lunch and learn and breakfast and learn and all the other stuff. I couldn't figure out how to make it flexible enough for me. Yes, sir. Okay, I'll stand right here maybe and go this way. So anyway, that's what you guys will be looking forward to seeing in terms of the invitation. It will be the Food for Thought will be the invitation here moving forward. Okay. I think in general, I always want to make sure that everybody realizes that the concept behind the educational events is, of course, to talk about things that are relevant. We've made a decision to stay on markets again today. We're incredibly blessed to have Apollo with us, which I'll introduce him in a minute. But I want to kind of ask for permission to do two things in these events. Number one is try to provide new insights when we can. Obviously, as the markets change, as economic conditions change, there are opportunities to talk about new things. But I also want to make sure that we're reiterating concepts that maybe you've heard before. I've talked to some of you about this, but in my life, entrepreneurship is big for me, and so I read a lot of books about it, and they all don't say different things. A lot of times they're saying the same things, but they're saying them in different ways. And I think particularly when you're aligning yourself with a firm and the investment philosophy that they use, it's really important to have that. So I think Apollo will do both, give you some new information and also reiterate some things that you've heard before. So with that being said, Apollo is with Dimensional Funds. Many of you know who Dimensional Funds are. The company is. And you have potentially heard Apollo before. I had him speak virtually through COVID, and actually once several years ago before COVID. So he's an amazing wealth of knowledge. If you saw his bio, you know that he's been named the Secretary of Explaining Stuff. Because secretary may not be an appropriate word.
Minister.
Yeah, minister. Because he's very good at taking complex concepts and explaining them in ways that you and I can understand. So really blessed to have him. He's been with Dimensional for 18 years, PhD in economics, and I think it'll be really great. So from a format standpoint, we're going to do it town hall. I will scream 4 questions at him. Because I just have some things that I think I've heard over the last several months in meetings and that I know the media is talking about. He'll address those, and then I'm going to open up for Q&A. For those of you who are at the last event, the Q&A was really valuable, and so it'll be wide open, and you can ask whatever you want. Okay? Sound good? All right. Thanks, Apollo. I really appreciate you being here. I'm going to step this way. Maybe I'll try to, well, Lenny won't be able to hear me if I step that way, so I'll stay over here. All right, so first question is just general market thoughts. I think, we've talked about this before, but uncertainty in the markets in a lot of ways right now. Obviously, we've got geopolitical risk, we've got Fed interest rate action, we've got China's zero COVID policy, and so I just wanted to kind of give you a chance just as an opener to give us some thoughts about the current market conditions. If there's things you think that everybody in the room as investors should be thinking in the current markets and just kind of how you're seeing things.
Eric, well, first of all, thank you so much for the invitation to come back, and thanks to all of you for coming. I think, it was a few years ago when we did this. Not as nice of a venue, but it was still a great event. So thanks for joining today. So let's start with the talk about the market, because how many of you are paying attention to the markets? They're kind of watching it. So what's your feel right now? How do you feel about it? Well, what's interesting is that even like among these opinions, there's some like in the middle, some thumbs up, thumbs down. What's interesting about the markets is that this year we did have a negative year. As we know, the S&P 500 is down roughly about 15% year to date. And I thought about this because it's not pleasant to see money going down. And there's, to your point, there's so much going on in the world, and it seems that is creating almost like an unprecedented type of event. And what I wanted to figure out is put some context around this. So we're seeing the market go down. How unusual is it? What are some of the drivers of this? And what does it mean for you going forward? So start with like what's driving this market downturn. And what I have to say, what's fascinating is that the last 15 years almost, we had two negative years. We had 2008, that was almost 14 years ago, when the market dropped significantly. But then after 2008, for years and years and years and years, we were positive for about 10 years until 2018. And in 2018, the market dropped. Anybody remembers by how much the market dropped in 2018? Was it a big drop or a little drop? If it was a big drop, you remember it. So, it was a little drop. It was about 4% drop. In other words, over the last 15 years or so, after 2008, we had one negative year in the stock market, and that was in 2018. It was a negative 4% drop, which is not a huge drop. It's not pleasant, but it wasn't catastrophic. And what I've been kind of thinking and meeting with investors is that we have gotten used to a type of a market that just goes up and up and up and up. And as I look at the history of markets, that is not the nature of stock markets. Stock markets are about ownership in companies. They're not a gambling casino. They're just ownership in companies. You are allowed to buy ownership in Vail Resorts and Boeing and AT&T and McDonald's and Coca-Cola and Google. That's what stock market allows you to do. And the value of the ownership depends on the profits, the earnings that you expect the company to make. If the profits go up, so does the value of the stock market. But it's never in the history of the world, it's never been the case that profits always go up and up and up. In the history of any firm, profits fluctuate. So when the profits are expected to go down, what does the stock market do? It drops, but it doesn't mean that it's catastrophic. It just means that the value of these companies for the moment is lower. And I think that we have gotten used to a type of market that goes up and up and up, and that's not necessarily realistic. In fact, one way to think about it is that what we're doing right now is we're just simply giving back the earnings that we got in 2021. 2021, it was a positive year. That's roughly the same drop that we saw this year. 2020, the year of the pandemic, do you remember what the market did? It was up 18%. The year before it was up. So the fact that we have a negative year every once in a while, I want to caution that it hasn't happened for a while, so we're all kind of right now staring in the face the possibility of a negative year, which might or might not happen, but if it does happen, it is not terribly unusual. So I want to start with that. I wouldn't freak out as an investor because the year today is down. And even if you look at the year and you say, well, this is not a good year, I lost money in the market. I know it's unpleasant, we know it happens, that's the nature of the market, but it's also very uneven. It's incredibly uneven, and this has been surprising to some people how uneven it is. This year, what are the companies that are doing really poorly? The tech companies. Meta, which is the parent company of Facebook. So Facebook has multiple lines of business. It's Facebook, it's Instagram, WhatsApp. They have WhatsApp. So they have all these businesses, and they wanted to put an umbrella across all of them, so they don't call them all Facebook, which is just one of the companies. So they call them Meta. So if you hear Meta, it's kind of the same thing as Facebook, what it used to be Facebook. Well, this year they came out and they said, listen, we're not making as much money as we did in the past. We're not really as competitive compared to TikTok and other platforms. And by the way, we're going to spend a ton of money on an unproven platform around virtual reality. So what do you think means to the value of Meta when they come out with that announcement? This is exactly what they said in February. It dropped, and it dropped by roughly 50%. So you have tech companies that have dropped. Tesla. You know, you have a gentleman who's busy with all kind of endeavors, and Tesla being one of the many, and ended up like Tesla's down 50%. Not necessarily because of the Twitter thing, but it's down 50%. So companies go up and down in value. But doesn't mean that all of them went down. Exxon. You familiar with Exxon? Exxon, year to date, is up roughly about 80%. So if you're saying the market's down, some parts of the market are down, like technology stocks, but some parts are significantly up. And there are tons of these companies that are still positive. So we're measuring the market as a whole, which is, in other words, a combination of good news and bad news. So that's the first thing that I want to mention. Don't think that everything is terrible in the market. There are some really bright spots, but you might be overshadowed by the fact that the big tech stocks are down for the year. And by the way, let's just flip the time machine back on. 2 years ago, in May of 2020, the big news beyond the pandemic, because everywhere there was a big news, had to do with oil. there was a moment in time when oil producers realized that it's more expensive for them to shut down production than to keep producing, even though there are no buyers. At the time, nobody was driving, flying was not really out of the question. So all these oil producers were pumping oil, but nobody was using it. So at some point, what do you do with the oil when you pump it and you don't have anywhere to use it? You store it, right? And at some point in May of 2020, this is 2 years ago, the storage facilities got full. There's nowhere to put oil, but you're still pumping oil. So for a little bit of time in 2020, 2 years ago, these energy companies producing oil, they could not sell the oil. In fact, they had to pay people to take oil off their hands. This is 2 years ago, not 20 years ago. And what were the high-flying companies 2 years ago? Technology stocks, remember? Everybody's like, well, we need Microsoft, we need Facebook. So this is cyclical, so it changes. That's just the dynamic nature of the world. So just to kind of start with that notion that when you see the markets down, there's not every company's down. Some are up, some are down. This is not something that is predictable, something that happens. And the best way to negotiate with this is make sure that you're as diversified as possible, that you're not placing bets on any one industry, on any one company. The second thing that I wanted to touch on is, so we talked about why is this happening. Secondly is, what is the perspective looking historically? Because this year, you heard a lot about the bear market, right? Bear market, that sounds ominous, right? Terrible. We don't want to hear bear markets as bad. Bear market means that from the level that the stock market measured by the S&P 500, for example, which is a broad combination of the largest 500 companies in the U.S. market, from a certain level that the index reached, it dropped by about 20% or more. That's what a bear market is. When it reaches a level and then it drops by 20% or more, that's called a bear market. When it goes up, it's called a bull market. So the question is, historically, what's been the pattern of bear markets and bull markets? And it was quite interesting because we wanted to know how often do they happen, and are they in any discernible pattern? Can you figure out a time when you know, hey, this is a time to kind of get out, and maybe the bear market's coming. So we looked at that, and we looked at it for the entire history of the U.S. market going back to 1926. So this is what we found. So this is a chart, a history of the U.S. stock market going back to 1926, where you really break it down based on times, periods when the market was in bear market territory, and this is what the yellow shows you. The yellow bars means that during those periods, we had a bear market. And if it's green or teal, whatever this is, that's a bull market. So that's going 26 to the end of last year. When you look at this, just visually, what's the first thing that jumps at you? Which one happens at not more, but you know, actually for a longer period of time? The bull market or the bear market? So the first thing that I notice is that bear markets do happen. There's no doubt in my mind that bear markets happen. It's the nature, it's the history of the market. Just happens they don't happen as often as the bull markets. They don't run as long as the bull markets. The latest bear market that we had beyond this year was in 2020, and that bear market lasted 1 month. 1 month. But in that month, it dropped by 34% in value. 34%. This year, we're down 15% for the year. 2 years ago, the bear market dropped the market by 34%. The last time before that, it was a 2 months with a 27% drop. And then you have 51% in 13 months. So you kind of see that these bear markets happen, but then you compare their length to the length of the bull market. Which one can last longer? Obviously, you got 153 months, 155, 62, 131 months. The bull markets run a lot longer. So it's good to see this and understand as an investor that you should expect. You absolutely should expect there'll be times when bear market happens. It's nothing unusual, nothing unprecedented. That's just the nature of the stock market. That's the price of admission. That's how you might make money in the market. Because if it went up every single month, would you still make the same amount of money if there's so much certainty in the market? Probably not. So to me, that's the first question. The second question is, can you find a pattern in this? Can you tell me there's a way to gauge when the next bear market might come or how long it would last? The only thing that we know is that they will come. And Eric, I live in Los Angeles, and we talked about it last time, I think. What's the one thing that I know it will happen in Los Angeles in my lifetime, hopefully? Well, not hopefully not, but still I expect it's going to happen in my lifetime. An earthquake. I know it's coming the same way that I know the market at some point will drop. But that knowledge of the earthquake, is it useful? Is the knowledge there will be a bear market at some point, is that useful by itself? No, you need to know when. And neither with the market nor with the earthquake can you actually tell when they're coming. So because of that, what we're suggesting to investors is to really acknowledge the fact that the nature of the markets is to fluctuate, and know that that's just the way that it works. So because of that, we really look at this as just it's the price of admission for being in the market and for the great returns that he had. No, I turn it off.
Oh, sorry.
I'm tricky like that. I wanted to see if you're on top of it. So that was the second question. So the first one is, why is this happening? Second is, what's the historical perspective? And the third one around the markets is, what should you expect next? Because my pet peeve is when I listen to the media and they're saying that the market is dropping. Dropping means that it's dropped and it will continue to drop. Dropping is a different tense for sentences, different verb. So what I am here to tell you is that the market is not dropping. The market has dropped. What the market does tomorrow is independent of what happened up to this point. And the question is, when you look at times when the market did drop by about 20%, what do you expect next? Because it's already happened. We can't do anything about it. But if you fast forward, do you see in the data, when you actually look at the data of the US markets, do you see there is continued pain and the market continues to drop, or do you see a rebound? And we looked at exactly the data after a 20% market drop, and this is what we found. Well, when you look at a 20% threshold, this is when the market declines by about 20%. And then he asked the question, on average, after this 20% decline, what happens 1 year out? What do you think? Is it up or down? Up. And in fact, what's remarkable, it is up by about 22%. So roughly the same level of a drop. So it is really interesting that once you see this drop, on average, there's really good news for you, because it's not continued pain, but rather there's a rebound. And even if you look 3 years out, your portfolio will be up roughly about, on average, about 41%. And if you look at 5 years out, it's still going to be up about 71%, which on average per year would be about 11% per year over the next 5 years. So to me, the good news here is that I can't tell you what's going to happen, but on average, after the market drops, the market goes up. And what does it mean for you? One thing that it could mean is that when you see these dips, rather than think in panic that I need to sell, that I'm scared that the market's going to lose me even more money, perhaps one of the strategies is to think of it as an opportunity to buy at a lower price. And that's what this system called rebalancing, and this is what Eric and the team do, when they see that something on a relative basis has dropped, that might be the time to buy. What's the fundamental premise in investing? Buy low, sell high. Pretty easy, right? Well, buy low means that when something drops, instead of selling more of it, you want to buy it. But you don't want to buy it like on a hunch. You want to have a system in place, and that's what they do and through the rebalancing process. So for some of you, this might be a good time to think about rebalancing. And that's important. And the last thing that I'll point out about this, in terms of perspective, we keep talking about stocks as the S&P 500. What is the media talking about stocks? What's the number one most cited metric for the US market if you listen to the news? The Dow Jones. So we talked about some companies doing well, like energy stocks this year, like Exxon, and some companies not doing very well, technology stocks. If you think of the Dow, how many companies are in the Dow? 30. How many companies are in the US market that you can buy ownership in today? 3,000 to 4,000 different companies. So what the Dow is doing is taking a subset of 30 companies out of 3,000, and they're telling you how the market's doing. How representative is that? Not very. And in fact, What's interesting is that Amazon, Google, Facebook, Tesla, none of those are part of the Dow. How can you possibly say, how did the market do without including Amazon, Google, Facebook, or Tesla? Can you? So I would caution you to say, how did the market do, and look at the Dow. But even beyond that, if you look globally, and we're going to talk about this, US is only one of the many stock markets in which you can invest. So in that respect, the US alone is only a component of a larger picture. So what the stock market means is different perhaps for you than it is for the Dow Jones media type of metric.
Awesome. So you mentioned what markets do after bad market or a bear market,
Right.
but I think one of the things that investors are thinking about now is, yeah, but we're heading into a recession, or maybe we've already been in a recession.
Right.
So I just want to hear some of your comments around, one, have we been in a recession? Two, will we go into a recession? And then three, just from a market perspective, are there some historical elements from a data perspective, or just your perspective about how investors should be thinking heading into a potential for a recession?
Yeah. So this idea of recession is so interesting, because when I first kind of ran into this word, I wanted to know, well, what's a recession? Because it wasn't obvious to me. And then when you Google, the first thing you see is like, hey, 2 negative quarters of economic growth. And I was trying to tell this to my wife, and she stared at me, what does it mean? It's like, it's true. I mean, what does it actually mean? So about 100 years ago, we just got out of the Great Depression, and the Congress wanted to know, is the economy growing or not? And 100 years ago, there was no clue. We have no idea. So they looked at this one economist, and they said, we are tasking you with figuring out a way to determine if the economy is growing or not. So this gentleman went to work, and he came back with an idea. He said, basically, what if we quantify everything that's being produced in the US, all the goods or the services, quantify it into a single number, and then we examine that number one quarter compared to another. If that number gets bigger, well, the economy is growing. If the number gets small, the economy is shrinking. Make sense so far? That was called national income at the time. Today, it is called gross domestic product. So if you hear this word GDP, gross domestic product, it just really reflects this one magical number. But to begin with, how easy do you think it is to combine everything that's being produced in a country like the US into a single number? It's not very, and in fact, quite often that number gets restated. As new information comes on, the number gets restated. But what was interesting to me is that when you hear about economic growth, it just really reflects this one number, that if it goes up, economy grows. If it goes down, it's negative economic growth. I'm not saying it's not a robust number, but it's not an incredibly precise, because it's very hard to compute. Now, about 40 years ago, in 1978, the Congress also recognized that this number by itself, it might not be the best way to figure out if we are in a recession or not. So what they did in 1978, Congress actually put in place a different way to determine if we are in a recession or not. And said that rather than find a specific metric, one single mathematical formula to tell us if we're in a recession or not, we're going to entrust 8 people, 8 academics, they're all professors, part of a group called the National Bureau of Economic Research. And the only people who can determine if the US is in a recession is this group of 8 individuals. And if they declare that we are in a recession, we are in a recession. If they don't declare that we're in a recession, we're not in a recession. It's true. It's not CNN or Fox News or you name it who decide if we're in a recession. There are 8 economists, and they're the ones who make this decision. You can Google it, or I can send Eric a few links. And here's the thing: what they have told everybody, these 8 economists, is that when we determine if we're in a recession or not, we look at the economic growth. So they definitely look at the GDP, but that's not the only data. That's not the only metric that they look at. Another one that they look at is unemployment. How is the unemployment in the country? And by the way, how is the unemployment today in the country? Low. Very good. They look at income growth. Are the incomes growing? Yes. They look at a lot of other factors, economic data, and then ultimately they also apply their own judgment. So this is what I want you to get. This is not based on a very strict set of criteria that he checked the boxes and we are an economy. We're in a recession. These economists sometimes apply their own judgment. And to make it so clear, the last recession that we're in, anybody knows when did the U.S. had the last recession? 2020, during the pandemic. How long did it last? 2 months. Could that have been a recession based on 2 negative quarters of economic growth? No, because there are no 2 quarters, only 2 months. But their judgment was that the economic activity dropped so much they called it a recession. So I would not get carried away and say we're in a recession or not because I heard one guy saying it on TV, I read something on Twitter. That's not it. Listen to these 8 economists, and right now they're saying, yeah, the economic growth for 2 quarters was negative, but it was counterbalanced by a lot of other positives in the economy. We don't think it's a recession, and as of now, they certainly don't think so because over the past 2 quarters, the GDP has actually increased. So even the one metric that might have signaled a dip, it didn't actually dip. Now, why did we talk about the Fed? Is that worth talking about the Fed at this point, or just keep on the recession? Because the reason that so many people are concerned about the recession is because of the Fed. The Federal Reserve has been increasing rates. You all know that. You heard about it. And what these increases in rates do, they potentially create a recession. Now, why would the Fed be creating a recession? Why would they, like, what's up with that? Where are they thinking? I mean, these supposedly smart people, why are they causing so much pain among business and consumers? And it's important to understand what's going on with the Fed if you want to understand the recession. So what's going on is that to understand this, we need to go back 40 years ago, 1970. So in 1970, it was quite interesting because there is a sequence of events that was quite remarkable. And let's all go into a time machine to 1970. What the economists figured that back then is that the way that we operated the economy was not sustainable. Why? Because at the time, in order for the government to print a dollar bill, it had to have a certain amount of gold in the bank. And that gave a lot of people in the country, they gave them the comfort that, hey, my dollar bills have value because there's gold behind them. And what the economists realize is that as the economy is growing, there are more people in society, the economy is producing more, we just don't print enough dollar bills. Just simply don't print enough dollar bills because there's not enough gold being excavated to back that up. So in 1971, President Nixon actually cut the link between dollar and gold. And at that point, gold was no longer tied to the dollar. And what it meant is that the government can run the printing machines day and night. There is no backstop because the value of the dollar is only backed by our faith in the paper bill. How would you have felt if today you're being told that the dollars are going from gold standard to a system in which the government can print as many as they want, run the printing machines day and night, no backstop? How would you have felt? How would you feel if that happened today? Would you be a little anxious? Would you say, well, this dollar is not going to be worth anything? They're going to just print so many of these dollar bills, it's going to be not worth nothing. Would you think that? Well, that's probably what the people in the country thought in 1970. And then on top of that, to show their displeasure with the U.S. policies, the OPEC, Organization of Petroleum Exporting Countries, they stopped sending oil to the U.S. And all of a sudden, you had a huge energy crisis. And I was just I was too young of a kid to remember, but my father-in-law was telling me about the times when he had to actually be in line to get some of the. You remember those? Yeah. Yeah, and so it was another huge shock to the economy beyond the cut from the cutting the link between dollar and the dollar bill and the gold. And then the third thing, there was a huge drought that led to very big increases in price of food around the world. So you take these 3 things in 1970, and that's when you saw inflation started to go up in about 1973. And inflation went up quite a bit. And a lot of people at that point were like, whoa, we need to do something about it. So they looked at the Fed and they said, listen, you Fed, you have a way of helping with inflation, because if, let's say you make it more expensive for companies to borrow, well, they're not going to build as much. If interest rates go up and somebody's mortgage goes higher, they're not going to have as much money to spend on other things, and that will reduce the pressure on prices. And that was the first time that the Fed started going up and increasing interest rates. Trouble is that as you increase interest rates, economic activity in the country diminishes. And when that happened, the Fed was like, whoa, 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 that's not good. Let's just maybe change the policy and stop increasing rates. Now, when it did this a couple times, these flip-flops, the biggest thing that happened was that it created the expectation of high inflation. People no longer believe that the Fed is serious about fighting inflation, and they expected inflation to stay high. And that's the fascinating part. When that expectation takes root, inflation becomes a self-fulfilling prophecy. Because if you're a union, and there are a lot of unions are very strong back in those days, if you expect inflation to be 10%, for example, if you negotiate a 5-year contract with the company, what are you going to bake in there? 10% increase in wages. If you are a supplier and you think prices are going to go up when you negotiate contracts with your vendors, what are you going to bake in? Inflation increases, and that's when it becomes a self-fulfilling prophecy. And that's exactly what happened throughout the 70s. Inflation stayed very high because people did not think that the Fed was serious about fighting it. And in the late 70s, somebody by the name of Paul Volcker, anybody remembers that name? Paul Volcker came along and he became the Fed chairman, and he said, whoa, 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 no more of this. I want to convince everybody in the country that I am serious about fighting inflation. And he started to increase rates and keep them high even as the economy was going into recession. And he was very purposeful. Not that he wanted to create a recession, but he said that the damage that can be done from high inflation and people not believing that inflation will come back down is a lot greater than the damage that a recession might cause at the moment. And if you look at it, 40 years later, he was kind of proven right. We had 40 years of really tame inflation because he convinced people, he reassured them that the Fed will do whatever it takes to fight inflation. So fast forward to 2022. Inflation is now high, and the Fed has the same dilemma in front of it. What do? Do we increase the interest rates, and perhaps the economy might dip into a recession, or do we maybe let the interest rates stay low and we might not have a recession, but we create that expectation of inflation that might carry through in the way that people make decisions? If you were the Fed, what would you do today? Huh? And by the way, that's exactly what they're doing right now. So as unpleasant as it is, the alternative is a lot worse. If they didn't do this, and if they were not to convince every single one of us in the room that they're serious about fighting inflation, inflation will stay high and spiral, and we would all be so much worse off. And is it working? Well, so far, every single indication is that, yes, it's working, that everybody's taking notice, and the fact that they saw, they're serious about it. So because they're so serious, they don't care if, not that they don't care, they wouldn't want us to be in a recession, but even if it happens, they're more concerned about inflation. So at this point, it's working. And to let you know, what the markets is signaling right now, when investors and traders actually invest money, what their expectation is that over the next 5 years, the inflation on average will be less than 2.5%. That's the expectation. There's a metric that, please go ahead and Google. All of you can Google it. It's called break-even inflation rate. The Fed keeps track of it, and it tells you what to expect in terms of inflation on average over the next 5 years or 10 years, you name it. And it's about less than 2.5% today. So in other words, the markets, the economy has gotten the message from the Fed. So if you see the Fed, the recession, why are they doing this? Is because the alternative is a lot worse. Now, coming back to finally the question on investing. There's one thing that is so crucial to distinguish. The economy and what's going on in the economy right now with the stock market. Because I noticed that quite often they're used interchangeably. Well, this economy, stock market, what's the difference? They're similar because they have to do with business, but they're not the same. Folks, they're not the same. So what's the difference between the economy and the stock market? The economy is about what's going on right now, the economic output, the unemployment, the price level, everything that has to do with this moment in time. The stock market is about ownership. And as you talked about it, the value of the ownership is not just the money you'll receive as a business owner today and tomorrow, but the year after and the year after and the year after. In other words, whereas the economy is about what's going on right now, the stock market is about the future. That's the biggest thing. And because the stock market's about the future, what they're really trying to do is assess. They're really trying to assess not just what's going to happen tomorrow, but years and years and years down the road. And that's the biggest thing. Sometimes, because the markets are forward-looking, sometimes when they see dark clouds on the horizon, even as things look good right now, but if they see the dark clouds, it's possible that the market might drop in expectation of those darker days coming. But it does this before it even happens. And the flip side is also true. If we are in a recession and it's a terrible economic time, it doesn't have to be that the market drops. Why? Huh? Because it looks ahead. It's looking at the future. And let's look at some examples, because there's some really crazy, interesting examples to look at. If you go back to 1980, we talked about the recession that was caused by the interest rates. If you go back to 1980, do you remember that economic year? Well, if you don't, this is a little snapshot. But unemployment was incredibly high. Economic output was very, very low. You had big inflation. You had retail housing start. Everything was terrible. Everything was terrible. And if you're an investor and you're in the middle of that terrible economic year, how do you feel about investing at the time? How would you feel? Terrible. This is not a good time to be invested. Look how terrible everything is around. The markets are forward-looking. They're trying to see what comes out ahead. So even as we are in those dark days, perhaps the markets see the light at the end of the tunnel and they price it in. So in 1980, this terrible economic year, the U.S. market was up 32%. Long-term average is about 10%. So in a terrible economic recession, the market can still go up. Not because the market's disconnected from reality. No, it's just simply it's forward-looking. After that, 2009, remember? It was the worst economic year since the Great Depression. That's what was labeled at the time. And the bottom of the market was in March. And in March, it was so obvious that things are going to get worse for the economy. And in fact, we didn't get to the 10% unemployment until October. And yet, in 2009, this horrific economic year, the stock market went up 26%. And you remember how you felt in 2009 about everything? It was so dark and gloomy. But it doesn't mean the market has to be that way, because the market's forward-looking. It saw the light at the end of the tunnel. And then 2020, the last recession, we had all these millions of people not staying home and not working, and the market went up 18% as well. So to me, the big thing that I want to convey to you is that the market and the economy, they're related, but they're not the same. And the difference is in the time horizon. One is about what's going on right now, the other one is about the future. And what it crystallized for me is, some of you remember the film. Remember the film, the strip of film? I used to have a black and white lab at home. My dad gave it to me in high school. And recently my daughter started to shoot black and white film. And it kind of something like an analogy triggered in my head that if you think about a film, and I actually just played around with this not long ago. If you think about the economy is a snapshot. It's a scene. It's a single frame of what is going on at the moment. This is what the economy is. The stock market, it's a much longer running movie for years and years down the road, because that's when the ownership will actually benefit you from years and years down the road. So this is one of the many, many scenes that a company sees in its lifetime. And how long can this last? Well, there are companies that have been around for over 100 years. Many, many companies. We talked about Exxon. On their website, they have a list of all the cash payments they made to investors going back to 1911. That ownership, paid off for 110 years. That's how long that market is. That's how long forward-looking means. It's not 1 or 2 or 3 years. It's a very long time horizon. So because of that, Eric, my thing is when you look at the markets, realize that even as the economy might be doing good or bad, the markets are forward-looking. It's not about what's going on right now. It's what they expect to happen next, and that tends to get priced in the market well before things happen. It's like if you see a train coming, you hear the train coming. Well, by the time he pulls in the station, don't be surprised. You know, he was on the way there. So it's kind of. Yeah.
Any thoughts on how Fed unprecedented spending will impact everything you just said?
Right. So the Fed right now is kind of raising interest rates, and I think there has been a narrative out there that the Fed is the interest rates have been really propping up the stock market because companies could borrow inexpensively, but now if they're not going to be able to do it, perhaps that's going to not be good for the stock market. So that's an interesting, and it makes some sense to examine that. What happens at times when the Fed is raising rates? How bad can it get for the stock market? So we looked over the past 20 years, I mean, because we don't want to go, I mean, we can go as far back as we want, but we looked at the federal funds rate, which is the one interest rate that the Fed controls. So out of all the interest rates in the economy, the Fed does not control the mortgage rate. They don't control your car loan rate. What they control directly is this interest rate called the federal funds rate, which is a very short-term borrowing rate between banks, typically. So when you look at it historically, what you see is the early 2000s, this federal funds rate was very, very high. It was 6.5%, very, very high. And then as we went into the recession about 01 and we had the 9/11 and so forth, then the Fed started to cut rates and they went down low. But here's the thing. You have here a 3-year period between 04 and 06 when you have a 3-year back-to-back-to-back increase in interest rates by the Fed. So that can give you a little bit of a case study example of, hey, what can happen when the Fed raises rates? And then we know that the financial crisis happened, so the interest rates went back down, actually close to zero for many years. But here's another period between 2016 and 2018 when once again the rates went up. So that's another case study to examine and say, when this happens, how does the stock market do? How bad can it get for the stock market? So it's worth examining, right? Let's look at these two case studies and see if we can find a pattern of some sort. So the first period in 2004 to 06. In 2004, the S&P 500 actually went up about 11%, 10.9%. In 05, it went up 4.9%. And in 2006, 15.8%. So you have 3 years, back-to-back-to-back increases in the federal funds rate. Did the stock market tank? In every single year, it went up. Every single year. What about 2016 to 2018? Well, we had a 2016 positive 12%, then we had almost 22% in 2017, and we did have a drop in 2018 of 4.4%. In other words, if you look at the Fed increasing rates, can you automatically tell that the market will drop? Can you? 5 out of the last 6 years when we had this, markets went up. They did go down 1 year, but there is no evidence to suggest that the Fed the increasing rates is necessarily going to be terrible for the market. Now, I'm not saying that the Fed increasing rates is irrelevant. No, it's not at all. What I'm suggesting is something else, is that the Fed and interest rate policies is one of the many, many, many variables that impact the profits of a company, the value of the stock market. And there are so many other variables that impact that it's not clear to me at all that the Fed is almost like a primary one, that you can directly link the Fed policy to the stock market returns. It's one of the many, 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 many variables that drive the market, but it doesn't seem to be a primary one. The way that I thought about it just a few days ago, because again, we're making cookies these days, is like if you think of a cookie and you're making you're baking the cookie, well, you put the ingredients in. You put the eggs and you put the flour, the butter, the sugar, whatever you put in there. And then ultimately when you mix it in, you can't really distinguish to say, aha, I can see the egg in there. No, you can't. It's like it mixed in with everything else. So there's so many variables that drive the stock market that's really not possible to say, aha, I can see the flour in there. No, you can't. So that's kind of how you think. It's a big ingredient mix, and this is just one of the many ingredients that actually leads to the outcome of a cookie. So that's kind of my thought on the Fed is baked cookies.
Last one for me. U.S. has outperformed international for quite a while.
Yes.
Multinational companies have exposure all over the world, and so I think one of the narratives is, do you really need to own things internationally? We talk a lot to everyone in the room about trends. I'm just wondering if you think any of the landscape has changed with respect to the importance of international and what to expect in terms of U.S. with international moving forward.
Yeah, no. So that's a very interesting question. So, U.S. is to a lot of folks as they look on your statement, that you look on your statements and you see that hey, it's doing really well. So naturally, you ask, well, why am I even investing in the other countries when the U.S. is doing so well? And a lot of these companies are selling abroad. So what's the point of investing abroad? My first thought is I have to understand the intuition. So what's the intuition behind investing abroad? A few months ago, I started to think a little bit differently. So the first thought that I had is that U.S. is certainly a place where you can buy ownership in companies, but is the U.S. the only place where you can buy ownership? And we looked at this, and this is before a few months ago, this has been a few years ago, and we looked at this exact question, and what we did is we redrew a world map not based on landmass, but rather based on the value of all companies that you can buy and sell around the world. So in the U.S., when you add up the value of Apple, McDonald's, Coca-Cola, Boeing, and so forth, Vail Resorts, and what you end up seeing is that the value of the entire U.S. market, all these companies combined, is roughly about 60% of the value of all companies that you can purchase as an investor around the world. So it's the biggest market by a long. I mean, the next one is Japan. It's about 7%, 6%. So it's 10 times bigger than the next market. So the U.S. is the largest market, and that tends to be reflected in the way that your money is allocated. The biggest stock market in the portfolio typically tends to be the U.S. market. But what you also see is that there are some countries, they're called internationally developed, and those are Germany and Japan and UK and Australia. And those also have companies in which you can buy ownership, and those amount to roughly about 30%. And then you have a third categories of emerging markets like India and China and Brazil and Taiwan, and those have roughly about 10% of the value of the investable universe. So in other words, 40% of what you can buy as an investor is abroad, and there are over 12,000 of these companies in which you can buy ownership. So the first thing that I want to take a step back, international investing really is not about countries. It's about companies. You're not investing in countries. You're investing in companies. And you're right. There are a lot of products that we sell abroad. But what if you put the shoe on the other foot? What's the other way of looking at it? What's being sold to us? Is it worth looking at those companies as an opportunity? And a few months ago, I was telling you that the one thought that I had as I walked, I live next to UCLA, and I was walking on Westwood Boulevard, and I was kind of blown away by the variety of cars that you see on the street. So you certainly see some GM cars and Fords and Tesla. Certainly they're on the road. So in that respect, yes, makes sense to own these stocks that are based in the U.S. But are these the only cars that we see? No, I mean, there are plenty of Beamers and Mercedes and Porsches around, and even great American brands like Jeep and Chrysler. Well, those are owned by a company that trades in Italy. If you want to own Jeep, you have to buy it in a different country. That's international investing. Budweiser, it's actually based in Brazil and Belgium. And then you have the Japanese cars. We all know the Japanese cars. Even brands like Land Rover and Jaguar, they're owned by an Indian company, Tata Motors, that you have to buy in India. You have the Volvo. My daughter just got a Volvo. You know, it's owned by a Chinese company. The brand is owned by Geely, which is a Chinese company. And you have the Korean brands as well. So to me, the big question for an investor is this: if it makes sense to hold Ford and GM, why not consider BMW and Toyota? Why not conceptually consider that as an investment opportunity? What do you think? Does it make sense? Again, you're investing in companies, not countries. They happen to trade in a particular country, but it doesn't mean that you're investing in some local taco stand. That's not what we're talking about here. You know, these are real companies and they're selling to us. We know all these brands. We're spending our money on them. So to me, that's the way I think about it conceptually. We're investing in companies, not countries, and we are familiar. A lot of American brands are owned by international stocks. Now, to the point that you made, over the past 10 years or so, the U.S. has done really well. And that's when the question came about, well, why not just buy U.S. companies? So what this does, and I know it's really tiny, I'm not going to suggest that you can read this, but this is a ranking of country performance from the highest to the lowest. And I know it's tiny writing. If anybody can read the first line, I'd be really proud of you. But New Zealand, there you go, thank you. So New Zealand, for the decade between 2010 to 2020, so for that decade they just ended, New Zealand was the best performing stock market in the world, better than the US. Now the US happened to be the second best performer. That's what the yellow line is. And that's when a lot of people said, well, why not just invest in the US? Look how well it did. Well, theoretically, they should ask why not invest in New Zealand, because that was the best performer. But let's just stick with this. So that's when the curiosity came around investing in the U.S. And then you want to ask, okay, so that's what happened 2010 to 2020. How consistent is that? So if you go back a single decade, do we see the same level of outperformance? What do you think? No. In fact, if you go back a single decade between 2000 and 2010, look where the U.S. was. The question that I would get would be exactly the opposite. Why do we even have any US? Because look, it's at the very bottom. That was a decade before, not, you know. And then you look and say, okay, what if we go back longer? So forget about 1 or 2 decades. And you go and you combine all these countries and then you compare it to the US. And we have good data going back to the 1970s. So this is what we find. For the last decade, 2010 to 2020, the US, this is the average annualized per year during the decade, you see that the US came up on top. The US performed better than international companies, international markets. Now, if you go back to 1970, which one do you think did better, US or international? International. It actually significantly outperformed over the decade. Did a lot better international markets. What about 1980s, US or international? International again. For another decade, international beat significantly US companies. 1990s, we had the technology stocks and just flying high, and the US outperformed. But what happened is we had that hangover, what's called the lost decade, and after this technology run, we had a full decade when you would have lost money in the US market. So when I look at this, decade after decade, is it obvious to you that the US consistently outperforms international markets? No, it happens, and it's good to know that the US is the biggest chunk of your allocation. It's also nice to know that there are times when the US doesn't do as well, and we have something there to kind of hold it up and not miss out. So to me, that's kind of how I think about it, is that yes, the US has done well over the past decade. Awesome. It was the biggest portion. I'm just not seeing either an intuitive reason or data reason to abandon everything else and say, let's plow all the money in Ford and GM. No, it's just in US companies for that matter. No, I think it still makes a lot of sense to invest globally. And, you know, this year alone, the US is actually doing a little bit better than international markets because the dollar is so much stronger. But the international markets, they're no slouching. I mean, anybody guesses the best performing stock market in the world? We're down about 15%, so you put it in perspective. Anybody knows what the best performing stock market in the world is up to like a week ago? If you did, I'd be like, I didn't know myself. Turkey. Turkey. They had a lot of turmoil, they have a lot of things, but the Turkish stock market year to date, it is, there you go. As of Thanksgiving week, there you go. Ta-dam. That was great. By the way, they're in the process of rebranding themselves because they don't like when people call them turkey. So there's a different way to pronounce it, which I don't know exactly, but that is Thanksgiving week. As of Thanksgiving week, it is turkey. It's great. Up 75%. 75%. Now, this is in US dollars, meaning you take their local returns, which are in Turkish liras, and you convert them in US dollars because that's what you see on your statement. How much do you think is up in their local Turkish lira? More or less? 125%. So, that's kind of the nature of markets. It's, by the way, Turkey happened to have been the worst performer just the year before. So don't get carried away. But that's the nature of emerging markets. They fluctuate a lot in value, but you also have some really bright spots in there. So I wish I had put all the money in Turkey, not the bird, but the country. Anyway, so I'll pause here because I don't have my watch. It's being charged right now. So yes.
You can open up Q&A, yeah.
We have.
Question.
Yes.
You're all talking about past history of downs, ups, downs, ups, downs. I think of current history. We have China not going away.
Mm-hmm.
Putin's not going away. Iran's not going away. We have turmoil in this world. What is that? How are we supposed to think about what we do with our portfolios regarding, and from what I see, including myself, I think the majority of this room are senior citizens. Can we wait another 20 years? I know I'm not going to make it 10. I hope I make it 10. So can you comment?
Yeah. No. So the question is, listen. It's just if you don't mind, I'll paraphrase a little bit. It just feels different this time. Because there are all these things that are happening right now between China and Iran and the war in Ukraine and all these things. So somehow the world feels different. And when you look at this, probably the first question is how relevant is the past history when you have this situation today? And the second part of the question is, with all these ups and downs in the market, if you don't have enough of a time horizon to withstand them, well, what do you do then? So I'll answer maybe the second question first. So the interesting thing about the market is that whether or not you should be invested in the market is not a clear answer. In fact, the answer that I would give you is it depends. It absolutely depends. And what does it depend on? At the very fundamental level, it depends on the plan that Clear Creek has created for you, because that financial plan has to account for your time horizon. By the way, not that I'm trying to be flattering, but you do look great, so I'm not sure why you you're in 20 years. But if you're 75, which I didn't mean to put you on the spot today, but in case there, I'm 53 and I'm really proud that I'm still but. If you are 75, I think if you look at the insurance tables that look at what are the chances to live to different ages, I think you have a really good chance that either you and your spouse to be in the mid-90s. My dad passed away at 93 this year, and it was just unlucky. Somebody made a bad joke, but I'm not going to repeat it. Try to cheat on my mom. But no, he had an amazing life, and I wouldn't be surprised if the planning that you have to do is actually for the next 20 years. Because of the way that medicine is going, the way that we're all taking care of ourselves a little better, I think the planning, whether or not it will happen, though, the planning has to be a long term. Now, my point to you is that whether or not you should be invested in the market and how much, it depends on the plan. Because when Eric and the team, when they look at your circumstances and they figure out, okay, if you have a pension that's probably a different type of allocation than if you don't. Because if you have a pension, then you rely on that every 2 weeks or every month to carry through the rest of your life. If you don't, it's very different. So what happens quite often based on the plan, that you might not put all your money in the market, particularly at a later stage in life. But a part of your money, instead of being put into the stock market, which is about ownership, you actually can lend your money to corporations and government with an interest rate that is well established into a contract, and that carries still some uncertainty, but a lot less uncertainty than the stock market. And those are called bonds. So at some point, some of you, at some point in your life, you might want to have a little bit of a change. What you might have had in the mid-50s might be different than what you have in the 70s in terms of the allocation between stocks and bonds. And there's not one specific mix that's ideal and perfect for everybody. What you find is that it's very custom, and this is what Eric does with the planning. Is just for your needs, for your circumstances, for your risk capacity. Can you sleep at night? There's a specific mix that you want to put there between stocks and bonds. So at that point, your allocation to the stock market might actually be much more diminished. You might not be invested. I mean, that's, again, I don't even dare to guess to put a number. But let's just say that you are now invested in the market. You need to have some money. Quite often, the idea of being invested is scary because it takes a long time to recover at some point in history. It could take years to recover the losses. So there's a book that we have, and I'm sure you have it in the office. If not, I'll be happy to send you as many copies as you want. But this book, basically, it's called the Matrix book, and it's a big book of data. And it really looks at the performance of the market and how bad can it get and how long can it stay bad. So quite often when you think about investing, you look at the S&P 500, and these are small numbers. I'm not going to expect you to do to read them, but here's what these numbers are. This little matrix. Do you remember those triptychs that you had, the distance between Denver and Kansas City, that you look on the map and what they cross? That's kind of what this is, but instead of the distance in miles, is the average return per year annualized between two different years. That's what it shows you. It's just basically, if you look between 2000 and 2021, on average, annualized per year, the S&P 500 was about 7.5%. That was the sort of the number, the average annualized per year, 7.5% for the past 20 years or so. But I'm not looking at the number. What I want you to look at is the number of periods in red. So how many years can you be in red, meaning that on an annualized basis, you would be underwater? And if you look at 2000, you would have been underwater, 2000, and then for the next 1, 2, 3, 4, 5, 6 years, 6 years, you would have had a loss if you had invested in the S&P 500 in the U.S. market. Do you see that? Okay, so it's only the seventh year. It's only the seventh year when you basically break even. So it can be a long time to be invested in the market and you be underwater. That's scary, isn't it? You have 7 years to be invested and be on the water. That's why stock investing can be very scary. And look at 2002. Can anybody see the number? How much did it drop in 2002? 22% in that 1 year. Now, the reason I brought this up is because what I'm suggesting is that if you have a plan, and that allocation that Clerk has is diversified, and he has a portion of the money into the S&P 500. But they also put in small company stocks, value, international, emerging markets. But they also put 40%, let's say, in bonds. This is a pretty arbitrary number, just to illustrate the point. You put 40% not in the stock market, but in bonds. How will your experience be different if you now have this much more diversified allocation? So this is exactly the same metrics over the same time frame now in the portfolio that is balanced between stocks and bonds and really well diversified in stocks. How many years of red can you see at the most? So you have to look vertically to see how many years, what's the most? How many years you would have been in red before you come back into black? 2 years. 2008 and then 2009, these 2 years. That's the only 2 years. By the third year, you're back in black. So in other words, if you are invested with this more balanced allocation, what the data shows is that you're not going to suffer the same level of pain as if you just simply looked at the market. So when you say I'm invested in the market, most people that I know are not invested all in the S&P. They're invested much more in a balanced allocation in a much more diversified way at the stock level. So even in 2002, you see that the drop of 22%? In this case, what was the drop in 2002? Can you see the number? 4%. Instead of 22, you're only down about 4%. So to me, when you're asking that question about, hey, what should I be doing? To me, you have to look at your plan, and it might be the case that for you, you might have maybe 60% in bonds, not 40.
Right, but the plan of, are we on the verge of World War III?
So that comes to the next question. So the plan takes account of your financial needs. So it's a financial plan, not the plan of the world. I don't know that I have that. Eric might have one. But this is financial plan. That's what I was meant by financial plan, that somehow dictates your stock bonds allocation. But when it comes to that question, so is it different this time? I used to say that it's not different, but we've seen something like this before. And then I listened to myself. I was like, who am I kidding? Of course it's different. I mean, my lifetime, we've never had this confluence of the war, inflation, pandemic. All these things that are happening right now are pretty unique. So I'm not going to tell you that it's not different. It is different this time. Every time, I just wanted to know, even as it's different this time, how do I think about this being different? And does it mean that the rules don't apply anymore? And the thing that kind of caught my eye was over the past year or two, I started playing chess. Anybody plays chess here? All right, good. So I'm not going to ask you a position, but here's the thing that I noticed. I play quite often on the chess app. In every game that I played, there was never a situation when I ended up in exactly the same position in two different games. Has it ever been the case to you that you end up in the same exact position in between two games? Has it ever happened to you? The exact same position? It's always different, right? It's always different. But even it's always different, there's a fundamental premise that stays the same always. You have a chessboard, you have black and white squares, and you have the same pieces. So the question for me was that it is absolutely different this time, the same way that every chess game ends up in a different position. Now, what is the premise that still stays the same? Because as I told you, in the early 70s, we had the issue with the gold. We had the issue with OPEC and the oil crisis. We had the Iran. You remember talk about Iran when they took over the embassy. I mean, there are a lot of things. So this is different the same way that every game of chess is different. Now, what is the same premise? What's the chessboard in investing that gives me confidence that even as I look ahead, it's still going to be an optimistic outlook? And to me, the chessboard, the fundamental thing, that the premise that stays the same, is that we live in a free market society. It's not perfect, but it's a free market society by and large. And the reason that matters is that in a free market society, companies are looking to find ways to make money in whatever state of the world we might be in. And we have seen this over and over and over again, that in free markets, companies are free to search for ways to make money. And that's the premise that has not changed. As long as companies are looking to make money, they'll figure out a way to navigate whatever times we have. And you remember 2 years ago? Distilleries were brewing hand sanitizer because that's what's sold rather than spirits. You had Airbnb, instead of vacation, they were promoting hey, go work remotely for 6 months. You had all these airlines figure out how do we make it work. So it is absolutely true there are times when crazy things happen, but it's the fundamental premise of companies looking to navigate times. And when a CEO goes to work, what do you think their first priority is for that company? How do I make money? That's their job. Not every company is going to make money every period, but by and large, the system of free markets is the chessboard of investing that I think it's the same premise. When that changes, then yes, we will have a different discussion. If we become a Cuba, North Korea, Venezuela, yeah, we'll have a different discussion. But to me, as I thought about it, what is probably the darkest days, talk about things being different, the darkest days of our parents' generation, what do you think it was? Like millions of people dying, cities destroyed, everything. What was it? World War II, right? Would you agree that World War II was a terrible period? And don't ever say that war is good for business, because forget about, you have no consumers, everything gets destroyed, supply chain, all that. So I was curious to see, how did the stock market in the US navigate something that was truly different? Truly different. Yes, we have issues right now with China and COVID and all that, but that was different, and that was bad. That was really bad. So I actually looked at exactly that. How did the U.S. How did the U.S. Market do during those terrible years? So this is what I found. It was so fascinating. Is that if you look at the beginning of the war, and this is back in September of '39 when Germany invaded Poland, and you're an investor and you're kind of being asked, let's put money to work, and you just read the newspaper the same day saying, well, Germany just invaded Poland. Are you crazy? I mean, this doesn't seem like the right time to be invested. And then you fast forward 6 years to the end of the war in August of '45, and he asked a simple question. How much money would you have made or lost over the course of the 6 years of World War II? I mean, the intuition is that it cannot be a good time for the market, right? You would imagine that you lose some money. I don't know how much money, but that was kind of my thought. You lose some money. It turns out that during the 6 years of war, this global devastation, $1 invested in the U.S. market by the end would have doubled pretty much. $1 invested at the beginning of World War II would have pretty much doubled. And to me, it's not that the markets are crazy or war is good for business. To me, what really resonated was that companies figured out a way to make it work. And you had Ford and GM. They couldn't make cars. Nobody was buying them. What do they make? Tanks. Talk about Jeeps. I rented a Jeep with my daughter a few years ago, and on the handlebar, there's a little marking that they put there. I don't know if any of you have a Jeep at some point. You know what it says? Since 1941. And it kind of stuck on me for a second. I don't know. So I got back on the plane. I was like, what does it mean since 1941? And then it hit me. Why 1941? World War II. That's when they start making them and selling them to the U.S. military. And you have 7 years later a company or 8 years later that's thriving. So to me, the big thing here is that it is different. It is absolutely different. But the fundamental premise of companies trying to make it work has not changed. And if you look at the U.S. markets per se, you can say, okay, that was global, but we're not involved till December of '41. This is the incredible, incredible thing to me. If you look at the full years of war, 42, 43, 44, 45, the U.S. market in every single year made you money. And it was a positive outcome for investors. So I certainly did not expect that, but to me it kind of goes back to this idea that companies found a way to make it work, and that is the premise, that's the chessboard of investing, and that's, even as it's different this time, I'm not going to go and say the rules of the games have completely changed. Those rules would change only if we don't operate in a capitalist world, if we're not in free markets anymore. As long as we're in free markets, it might not be pleasant on the moment, but I don't see it as game-changing. Yes?
When I watch the news at night, I'll often hear somebody say, the market was down today because investors are worried about, and they'll give you a reason.
Yes.
And then the next day the market's up a bit, so I guess investors are no longer worried about that reason. So my question is, how much stock, if anything, should I put in these news reports that I see about the market, or should I be watching them at all?
Right. So Howard's asking, like, hey, listen, if you watch the news, one day you hear about the markets being concerned about this, and the next day is no worry concern. To me, the first note is that I think that there's there's a way in which media tries to simplify the whole world and find a simple explanation that covers everything. So to me, I would never, ever, ever pay attention to those, because every single company gets impacted by different things. The same exact event might be a big impact on one and not a big one on another one. The second reason I would never pay attention to that is because the markets are forward-looking. So in other words, if, for example, you hear in the news that the Fed increased interest rates and the market moved, a lot of times there is already the expectation of that happening, and the change in price happened when the expectation was formed. Unless there's something unexpected, then you might see the market. But I would not put any stock into those predictions because they really are a simplified way to try to, really show the people the way I understand the inner workings of the market. But we don't. There's so many companies driven by so many things that, no, I would not put any stock in that. That's not a valid way. Yes?
I'm very confused by the government saying inflation is not very high, but they don't include energy and food. It completely baffles me because I get hit in the face with that every day. Can you explain that whole concept?
Yeah, so the idea of inflation and how do you measure inflation, and there are different measures of inflation. There's not a single measure of inflation. In fact, computing inflation by itself is an incredibly hard task. I don't know if you know, but the way that the government does it, there's almost like a phone book, and you folks remember what a phone book. I've been in audiences like, what's a phone book? But there's like 600 pages of every single item that he can purchase. And there are people calling exactly the same store, asking exactly the same product and how much it costs. So that's how the government does it. So that basket is called Consumer Price Index. So there's one measure of the Consumer Price Index that includes energy and includes food, and there's another one that doesn't. So both of them are published, and it depends on which one you might have seen on a report, but both of them are available for you to see. So it's not just one or the other. It's just your news source that you might get it from my only report or one or the other. But I can tell you, like, we can pull up right now both with energy and food included or not included. So it goes both ways. Yes?
Along those lines, I'd like to know, is there such a thing as a senior citizen consumer price index?
Is there a senior citizen? One of the senior citizen consumer price index. The hard part is that this consumer price index, when it was designed, it was supposed to be the representative consumer. And again, you're trying to bucket into this one category all the consumers in the country. And as you said, there is a subset for seniors. I'm not aware of having anything specifically for seniors. No, I'm not aware of that. I just, no. But you're right, there's a different type of consumption that you might have. So no, and even within seniors, I imagine you have the early seniors that I just got done with work, so I want to travel the world, and my father-in-law is right now he's still happy, but he doesn't feel like traveling as much, so, yes.
You talked a while ago about corporations, they want to make profits. That's the rule of the game.
Mm-hmm.
But now we have something called ESG,
Mm-hmm.
which potentially changes the game. Can you comment on that a little bit?
Yeah, so we talked about companies wanting to make money, but something over the past few years that emerged called ESG. So what is ESG? ESG is an acronym that stands for environmental, social, and governance. And those three concepts are actually, from my perspective, they should not be used at the same time. Because when you're talking about environmental, basically what you're suggesting is that company creating pollution, or is it, from an environmental green perspective, what's the scorecard for that particular company? And different companies, even within the same sector, they have different scorecards. Some do better than others. So sustainability, the sustainability or the environmental piece, I think that's the E. The S has to do with social, and social becomes even more subjective. Because, for example, there are a group of investors who say, we don't want to put any money into companies that have tobacco, or they produce a certain type of product. And that's a social criteria that quite often could be associated with a religious belief that some have and some don't. And that's the social criteria. And that by itself is very different than environmental. And the governance is, how is the governance of that company? Is as something that, are they respectful of all groups? Do they do a good job as stewards of the company? And that's a third bucket by itself. So when you say ESG, I think it's combining different elements that should not be combined. And to me, when you look at ESG investing, if you are thinking about ESG investing, it is simply a reflection of preferences and personal values. There are some people who really would prefer to align their personal views with the way they invest. And years ago, I had somebody in Connecticut, a group like this, where basically a group of people said, really, what we got really excited is about a vice fund. And I don't know, what is a vice fund? Well, yeah, so that's what they wanted, and it wasn't a joke. Like that's kind of what we really, that's kind of like really want to party. That's what we want to do, and they wanted the vice fund as a personal preference because I'm not sure there were their values, but there was just something that was interesting to them. The same way you have some people right now who are really interested in sustainability. And they feel like there is a need out there in the world to basically change some things so we're not really hitting a wall when it comes to, you know, a global warming or whatever the case might be, the climate change and whatever. So for those people who have that preference, I think that what financial industries has been able to do is basically say, you can have the regular funds, not a problem. If you're not interested at all, that's fine. They're a set of regular funds. But if you have that specific value that you want to align with your investments, like sustainability, then there are a set of funds that basically look at companies not just on their investment potential, but also at their credentials when it comes, for example, to environment and sustainability. But that's a personal preference. It doesn't mean that the world as a whole is moving in that. You know, we have clients who, I mean, I travel a lot, and there are parts of the country where sustainability is a big deal. I was in Sonoma, and those folks for years had to deal with fires. Their homes were burned over and over again. And I feel for them because they do believe that this climate change is impacting their lives, and people died because of the fires there. So for them, they feel like that's closer to their heart because they've been personally impacted by that. And they want to align their values, and that's just a personal preference that they have. So it's not everyone, so nobody's pushing anybody into one direction, but for the people who have that, it's available. But I wouldn't say that the world is changing and requiring firms to do this. It's
Apollo, I
Yeah.
just want to make sure we're respectful of your time.
yeah, no, I mean, as long I don't want to hold anybody hostage. I mean, yes.
Can I buy the vice fund?
I'll go talk to those people, but it wasn't us who created it. Like, they're asking us, can Dimensional create a vice fund? Yeah, maybe not. Yes, Don.
Well, my concern is the interference of government and I don't think you really addressed that, because we've seen over the last couple of years where a business might have a great plan, especially in the oil industry, and then the government comes in and shuts it right off. So those things are beginning to influence us all
Right.
in our daily lives.
Right. So what about the influence of government in the day-to-day business and so forth? Is that happening? You know, and I would say that I can't say that I would apply a blanket across all industries. I think some industries might be more regulated than others. And you're right. I mean, there have been times when the government, the regulations, maybe the burden that comes on the firms have been a little bit greater. What I'm talking about is that the more of the fundamental premise, even if there are some burdens, some regulations, is that something that has never been the case, or is it tremendously more today than it's been in the past? And we looked at this, and there are times that the government really stepped in. And for example, they nationalized railroads or the steel industry. There are times when, you know, they walked in. You remember that picture of Woolworth kind of being pulled out of his chair, kind of carried out of his. I mean, there are times when the government in the past has done as much, if not more. But the fundamental fabric of the free markets, like a McDonald's, a Coca-Cola, an Apple, the government regulations, I'm not sure that they are to the point where it impacts their ability to make money. Now, certain industries said oil could be the case, that there are some regulations. I'm not sure that that's unique. That's the first time that it's ever happened. I think a lot of times some industries have been more heavily regulated, and this might be one of them today.
I'm not talking about regulations, I'm talking about their decisions. Like when Biden took over, excuse my example, but I mean, he shut down that pipeline.
That's right. So that's
That was something that, if I'm in the oil industry, I don't know if I could predict that.
yeah, no. So the question is, well, what about if something like the pipeline gets shut down? So that was I think it was kind of like the I would put that into the regulation category because it had to do with the environmental regulations. But what's interesting about energy per se, and I'm not an expert, but I was in Montana talking to a lot of folks who are in the energy business, and what's been interesting is that what they're seeing is that not only that there's less accommodation from the government, but what they're seeing is that the capital markets are also kind of pulling back a little bit, because what they're seeing is that if I'm going to invest a lot of money into the pipeline, will I be able to get the money back? Because it doesn't seem that the future of the world is in that direction. Like if you look at the direction of traffic is not going towards energy of that sort, or it's fossil fuels. So it's possible that we might still have it, but I think the financial markets are asking the question, is this a worthwhile investment? So what I heard from those folks in Montana was that beyond the government, the big issue they have is that the capital markets are not putting as much money to work just because they don't know if that investment will pay off. Because some of these investments are very long term. So I think it's a little more complicated, particularly with energy. I think it's a transitional phase. I think a lot of folks are realizing that we do need oil, there's no doubt. But that's a niche. That's an interesting concern, but would it be like the railroads maybe 50 years ago, 100 years ago? Yes, was there a question, or should we kind of like, I might as well, yeah.
I know.
Yeah.
Talk a lot about the market, the term market. I mean, GE has a value, it goes up and down, it's a value of all these other companies. But who is the market? Who's doing this trading? We got day traders, computer traders, we got investors, and all of these, and the people in this room are primarily people that buy and hold. I mean, I'd like to know who is the market?
That's a great question.
These numbers.
Yeah.
These numbers.
So that's a great question. So the question is, when you look at this and you see GE has a certain price and as a company has a certain value, where does it come from? Who is the market? Who makes this market move and go up and down? Because a lot of us in this room, they're probably like, okay, we're going to buy something and sit on it. But who actually trades and who determines this? So in the market, it used to be that up until about 20, 30 years ago, the majority of the people trading were retail investors. So they're folks like families that had money. And they would basically call a broker and they say, I'd like to buy and sell a stock. And there was a minority of folks who were institutional investors. In other words, these investors are professional, that if you are a mutual fund, what it does, it says, okay, if you're not sure how to invest your money, I'll give the money to a mutual fund, and the mutual fund will figure out what to buy and sell on my behalf. So then I just get a share of the pie in that mutual fund. So at that point, a portion of the market participants were these mutual fund investors. And these mutual fund investors, these professional investors, what they do is they study the financials of a company. They look and they talk to the vendors. They find as much information as possible about that company, and they form an expectation about the potential earnings that the company will have. So they have what's called valuation models. And in valuation models, they try to figure out how much is this company worth it. And if they find that the price at which the company sells, let's say it's $25 right now, if they see, I think that the value of this company should be closer to 30 or 35, then they go out there, they take the investor's money, and they go buy those shares of ownership. And as more and more people pile in and buy, the price of that increases to reflect the fact that they think it's worth more. So a portion of these investors are these professional folks who study the numbers all the time. And it used to be that until about 30, 40 years ago, these were a minority. And the majority were more individuals who were trading more on, I have some money to invest. They were really studying the numbers as well as these professionals. And over the past 30, 40 years, there was a huge shift. Fewer and fewer money in the market came from individual investors directly. And a lot more came from professional managers, to the point where today, when you trade, the vast majority of money being invested are professional investors who take money from individuals and deploy on their behalf. So a large chunk of the market right now in terms of who trades are professional mutual funds or institutional investors. That's the majority today. And the way they establish the price, they just simply look and say, I think that the prospects of these companies are good, and the price at which it trades right now, it's too low, so they go and buy that. And other people think the opposite. Like, you know, they might have a different valuation and a different view of the company, and they might be the ones selling. So that's kind of how typically it's determined. It's a valuation that more professional investors do it than individuals. Today, just to give an example, there are more professionally managed funds in the US than actual stocks trading on the market. So it's incredibly competitive. Incredibly competitive. And the majority of trades are done by these professional investors. But they don't know exactly either. No professional investor knows exactly what the value of a company is. They just have an estimate, they have an expectation, and they go and trade based on expectation. And sometimes they're right, sometimes they're wrong. But remember, for every buyer, there has to be a seller. For every optimist, there have to be a pessimist. So, but that's kind of how the market is determined. So it's a value per share. And then to find the value of a company, you multiply how many shares they have with the price for each share, and then you get a value called market capitalization, which is the combined value in the market of a company.
Awesome. Can you turn off so I can use this?
Yeah, I'm done.
The other one. The other pocket. Not that one.
I did. I already
the other
turned
one.
off.
Oh, you did?
Yeah.
All right. Okay. Look at that. Nice not to yell. So just a couple quick things. Hopefully you guys really enjoyed this. I just want to tell you, Paulo, how appreciative I am of coming out here and spending the time hanging out extra. So really appreciate that. You guys, you know, every time I listen to them speak, our philosophy is so impacted by the folks at Dimensional, and most of you know this, but I just am reminded of the kind of over-sensationalized, unreliable information that comes out of the vast majority of the media, and compare that to the data-driven kind of authentic approach that we get from being associated with Dimensional and through that connection with the University of Chicago research. So super pleased for that, and I want to remind you guys that as you continue to put your confidence as an evidence-based investor, there are just so many things that go against the intuition, right? There's so many things that we think are true, and looking deeper helps us get such a better perspective, so I'm grateful for that. We'll try to get the food and the coffee right next time. Well, I'm told we'll have a two-way mic, so hopefully we'll get that figured out the next time. And I know timing is tough because we ran over, but I just want to make sure that I wish all of you happy holidays, and enjoy your families and have a great finish to the year. And we're appreciative of all of you, so thank you.